Hello and welcome to Raise Your Average. I'm Pierre Daly, Managing Editor of AdvisorAnalyst.com. My co-hosts are Mike Philbrick and Adam Butler, Principals at Resolve Asset Management Global. Today, we're going to be talking all about the Canadian ETF landscape, the North American ETF landscape, where the hotspots are, where ETF flows are coming to and going from. Our very special guest is Daniel Straus, the head of National Bank Financial's ETF Research and Strategy Group, which focuses on providing both institutional and retail investors with value-add and actionable investment research relating to exchange-traded funds. His group regularly publishes street-leading reports on the ETF landscape in Canada and the US, including theme pieces, flow reports, model portfolios, trade ideas, and strategy reports. Their ETF research has been regularly featured in media outlets such as BNN, National Post, Bloomberg, Les Affaires, and the Globe and Mail. He joined National Bank's ETF Research Group as a research associate in 2010 and was promoted to director in 2020. He holds a bachelor's degree in applied science and engineering from the U of T, a Ph.D. in engineering from Brown, and a Master of Finance degree from the Schulich School of Business.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of AdvisorAnalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
Daniel, welcome to the show. It's great to have you.
Thanks for having me. I'm happy to be here.
So Daniel,
Brown, eh?
Hey,
Hold on, we should press pause for a second.
Sure.
Mike's gonna want to interrogate you on your experience at Brown, right?
That's right.
go for it.
I will wait for that. Let's go with the flow.
We can-
I think
we
Pierre
can
had a
do it
good flow
live.
going.
That's all right.
Okay.
So
Okay.
we're gonna get to that anyway. Daniel, tell us about your background,
That's right.
and how or why rather did you decide to get into the financial business after your doctorate in engineering?
Sure. Yeah. Well, thank you, Pierre. As you could tell from my biography, I love school. I was a professional student for a very long time. I love school so much that I like to tell people that the third grade was the best 2 years of my life. I did repeat the third grade as I switched from one private school to another. But eventually, I went into science because I always wanted to be a scientist. I love science. I love math. I love technology. I love science fiction, all that geeky stuff, which maybe we'll get a chance to talk about at the end. I don't know. But I went into engineering in, roughly the turn of the millennium, thinking to myself that, who knows, in the early 2000s, when I graduate, the tech industry will be booming and I'll be able to find a job very easily and quickly. And that was 2002, right? It was the collapse of the NASDAQ bubble. Canada's largest employer of engineers at the time, Nortel, went from being an enormous weight in the TSX to basically hiring zero engineers this summer that I was graduating from regularly hiring over 100. And then I said to myself, I still really love knowledge, science, math. I'm very curious. Let me do the grad school thing and continue in a PhD program. And by the time I graduate from that, and 2008-09, after 6 or 7 years, the global economy will be booming. It'll be wonderful. It'll be fantastic. So sure enough, I surfaced from my submarine after defending my PhD thesis, which was on the subject of carbon nanotubes. In fact, it was called the Highly Ordered Carbon Nanotube Array and its Heterojunction with Silicon, Infrared Investigations. And it didn't work, basically,
Yeah.
But like a lot of grad school projects, it was a lot of fun. But when I finally did resurface, I noticed that the world seemed to be collapsing all around me. That's at least what the newspaper headline said. And again, nobody was hiring. I was looking for work in, working either for government research or industrial stuff. I didn't really want to do the kind of postdoc track, which is a kind of revolving door of going from one school to another, looking for professional academic positions. And I always had a hobby interest in business and economics. And sure enough, at the peak of the 2008-09 financial crisis, one glance at the headlines and I realized very quickly, I need to know about this or I'm going to have the wool pulled over my eyes by the kind of financial machine and infrastructure, which really seems to kind of make the world go round. When we were studying engineering at U of T, we have a little little expression. I think a lot of the engineers put it on their jacket. It says ERTW. It says engineers rule the world. Well, I don't know if they know about the banking industry or the finance complex when they're sewing that onto their jackets. I realized it's something I need to learn more about. So, why not do more school? I didn't want to do an MBA. By that point, I was saturated. I didn't really want another 2 years. So I found a 1-year program, a Master of Finance, which is a lot of the same material. It covers a lot of the same material as the CFA. And to me, it really was a literal crash course in, financial analysis, macroeconomics, accounting, which I had never seen before, maybe very little exposure simply as a hobbyist. And that was a true eye-opening and awakening for me. And I was very fortunate from there to go directly into learning about ETFs. One of my mentors at the program, Professor Pauline Shum, did a lot of research in ETFs. And it was something that I realized this is a very cool toy. It's a very cool technology. It gives you exposure to almost anything. It's incredibly efficient, and it really kind of drives costs down to the bone, passing on benefits to end investors. I really thought of it as unique in the world of finance as something that really does kind of help the little guy. So I started to study it more, and it was that process which probably gave me a little leg up when I went to interview with National Bank in the subject of derivatives and financial products. I thought what I would need to learn going into the interview was I needed to know my binomial trees and my option valuation, because we'd be analyzing structured products and Himalayan notes and baskets and things like that. I was very excited. I was getting my modeling skills already. And the first question I received was, what do you know about ETFs? Because sure enough, the previous head of research, Pat Kieflo, who went on to head up BlackRock and is now with Invesco, he kind of started up the ETF research operation at National Bank in the aftermath of the financial crisis, because so many new questions were coming in regarding ETFs. So that's how National Bank got its kind of toehold in the world of ETF research. National was already very much involved in ETF structuring and market making, but the research component was a very natural add-on, and I was brought in to be an associate. And now we're almost 12 years later, and I still feel like I'm learning. I still feel like every single day there's new facts in the marketplace that give me that kind of head-spinning feeling that I got when I, like I said, opened my submarine hatch from where I was studying my Ph.D. dissertation and started looking at the headlines of a financial world in total disarray. We've been through some boom-bust cycles since then, and I still, every day bedazzled.
I have a new market indicator now, and I have one question, and we can call it quits. I mean, are you enrolled in or completing another degree at this time?
If the ETF research thing doesn't pan out, I will go back to school and maybe get a PhD in finance so that people treat me like an expert.
Could you tell me when you make, because that'll be it.
Yeah, that'll be that's right. I would love to be able to publish academic papers on some of the stuff that we research on here at National. But maybe one day as a retirement project, I'll do that.
So Daniel, has it been useful? Has your engineering and mathematics background, has that been useful in terms of your analysis?
That's a great question. So, there are a lot of ways to answer it. I've learned as well in the world of finance that intangibles are very valuable, right? In fact, in this kind of new economy that we're in, the intangible assets on a balance sheet may in fact be the entire bedrock on which our modern financial system of technology and intellectual property is built upon, right? I would say that I'm not designing bridges. I'm not, designing circuits or anything like that, or even doing, low temperature experiments in a vacuum on carbon nanotubes in my day to day. But the intangible benefits of an engineering degree, I certainly do use. The kind of there's a certain level of responsibility that comes from being trained as a Canadian engineer. It's in fact why we wear an iron ring, and I have mine on right now. It's more of a signal on the trading floor where there's a few of us who went through the ringer of Canadian engineering degrees, and we give each other this little kind of nod as we pass each other on the trading floor. This is in the before times. Virtually, it's hard to do that, right? But that kind of constant level of checking your work, that level of rigor of being evidence-based and relying on data, that's something that I would hope I bring to the workplace. And I also feel very fortunate to be part of an amazing team with a diversity of backgrounds. I head up a team of 4 full-time analysts and associates at National Bank who we are just looking at the ETF market all day, every day. And we're not all engineers. One of us has a background in economics, the other in computer science, and financial mathematics. It takes a little bit of everything because, ETFs can represent any asset class under the sun, almost, as we've seen. And you really do need to be a financial jack of all trades to be able to analyze them. And the engineering component, I would say, is the least useful thing, maybe, that I bring to the table on a day-to-day basis because, database management, programming, Python, statistics, that is far more valuable, I would say. But intangibly, I look back at the program that I went through at U of T, engineering science, and I think, after having gone through that ringer, that kind of pressure cooker, you can handle anything that Bay Street or Wall Street will throw at you.
So over the 12-year span that you've been sort of probably one of the first full-blown ETF research desks in Canada, and if not North America, what have been some of the changes that you've observed in the ETF technology over the last decade?
Sure. So one of the big changes we saw, I think that for the first, I would say, half of my career, for the first several years, ETFs were very much synonymous with passive index investing. So synonymous, in fact, that sometimes certain brands were synonymous with ETFs, right? Like, maybe I'll name one now. Like some people would say, I want an iShares that gives me oil. There was a level of education that we had to do. And the synonymity of ETFs with passive was, and with ultra low cost, was something that I think was accurate at first. But now, as the ETF complex is kind of swallowing up the entire rest of the asset management industry, we're still in the early stages for that. It still has relatively low market share relative to mutual funds and other forms of direct investment. A lot of the kind of early markers of ETFs, being low cost, being passive, being highly diversified, being very, very liquid, those are the reasons we love ETFs. And we have an entire suite of analytical tools to assign metrics to each of those qualities. We're finding it's not necessarily the case that all ETFs have those features. You don't need to have those features to have an ETF. There are ETFs now for senior loans. There's ETFs for crypto, as you know. There are ETFs for all sorts of overseas assets. And I think, we may one day see ETFs for all very, very exotic and strange kind of combinations of derivatives and crypto assets. Who knows, right? But the kind of there's something of a holdover of ETFs as having those kind of Boy Scout attributes that gives the kind of modern ETF complex that a kind of lingering halo effect, which I don't know if it's entirely deserved. And I think that culturally there are some shifts that are yet to come.
Well, speak to those. What do you think so you've seen a great deal of shifts over the last decade. What do you think are the shifts that might be brewing under the surface and about to bubble up?
Yeah. So, okay. So there are a lot of ways to kind of attack that. So let's talk about what ETFs were when they were new, right? They were kind of anointed as the kind of next great frontier of asset management. They were going to kill the mutual fund. They're going to kill active management. And now people are starting to question, what's the ETF killer, right? What's good? Do you remember when the iPod came out? It very, very quickly became the kind of be all end all go to vehicle for MP3 listening, right? And MP3s had killed the record industry. And then absolutely every single new MP3 player that came out, there'd be breathless headlines that asked the question, is this going to be the iPod killer? Is this phone going to be the iPhone killer, right? I think ETFs are now in the gun sights of the asset management industry, and a lot of people are asking, what's going to be the ETF killer? And already, I believe maybe some of your guests have even attempted to address this question. I've heard direct indexing, for instance, be a possible way to do it. But in our view, direct indexing is kind of a kind of new technological dressing, perhaps a new, very sophisticated algorithmic dressing for an older technology, which is SMAs, right? Which have always existed. Now, they have their pros and cons, and in fact, some of them, for some clients, may indeed be superior to ETFs. We're not married to ETFs. And I think that coming down the pike, there might be a form of cheap and easy delivery of SMAs, which for some investors, not all, it may in fact be an ETF killer. Then another possibility is, who knows if the digital asset revolution really does take root in a kind of very comprehensive way with regulatory clarity and all the amazing innovations that you're seeing happen in the world of crypto exchanges, for instance, become absorbed into the world of equity and bond trading, even in terms of transparency and instantaneous settlement and all that kind of algorithmic automated trade settling. Perhaps in the future there will be digital baskets, there will be some kind of like smart contract form of bundling whole portfolios and asset management styles. And maybe that will kill the ETF. But I think that's a long ways off. And that's kind of like predicting self-driving cars. When's that going to happen, right? It's like a lot of, I think, innovations will have to occur in the world of software and artificial intelligence before we start to see major threats have occurred in the world of ETFs. So, I mean, that's me putting a little bit of my kind of pie in the sky prognosticator hat on. I still think that we are in the kind of very kind of smooth elbow of the hockey stick growing up in terms of ETF adoption. And in the near term, 3 to 5 years, I don't see anything threatening the kind of dominance of ETFs in the mindshare of especially new young investors. Because they are so cheap, easy, convenient for the most part.
Any thought just what, like the taxation, the sort of unevenness of taxation in the U.S., which may or may not be addressed at some point in the future. Do you think that plays a role in there at all?
I do. So Mike, just a little bit of background in case the listeners aren't familiar. You often hear when you're given the long laundry list of what makes ETF so wonderful, tax efficiency on the list. And I don't know if we play back the tape if I said that, right? I said they're ultra low in cost, they're highly, highly liquid, very, very diversified, high performing, and tax efficient, right? That's often added to the list of the kind of Boy Scout attributes that ETFs have. And certainly amongst my U.S.-based ETF analyst counterparts, they will list that attribute as one of the chief selling points for ETFs. And in the United States, it's true. They do have this almost unfair advantage via the in-kind redemption mechanism to kind of ratchet up cost base internally because of their lot accounting method, right? In Canada, we don't have that. In Canada, ETFs are much more similar to mutual funds and have to do average cost-based accounting. They can do other little tricks with proxy securities and so on. And by and large, a passive strategy, which is market cap weighted, already has very low turnover. So there won't be necessarily tax events coming from, new additions to the portfolio and dispositions on a routine basis if you're in a cap weighted index. But the playing field is not the same. ETFs in the U.S. do have this tax advantage. I wouldn't call it an unfair advantage. And if I could backpedal a little bit, It's not really an unfair advantage. It is an advantage. But what's really unfair is the way mutual fund taxation works, the way that the tax bill is delivered once a year. And if you are a mutual fund long-term unit holder, you have to bear the tax burden for all these entrants and exits that occur over the course of your holding period, which have nothing to do with you, right? That's a little unfair. So if anything, perhaps there will be some kind of amendment to tax codes in the U.S. where the mutual fund industry will be able to pass along some kind of like NAV or price-based, cost-based tax treatment to their investors so that they can be on equal footing with ETFs. I don't know if that'll ever happen. In fact, it's more likely that it will happen when the Vanguard patent expires in 2023, and many mutual fund companies will be able to list ETF shares on an exchange, and then will be able to engage in these so-called heartbeat trades so that they can wash out tax gains exactly the way Vanguard and other companies can do it if they have, multiple share classes. Now we're getting deep into the weeds, into the kind of plumbing of how ETFs operate and where their advantages come from. But it's a very good question. I think that it's something we do think about. It's something that we're monitoring, and I think that tax advantage is why the U.S. ETF market is in fact twice as big on a representational basis as Canada's. Right? In fact, more than twice as big now. The U.S. ETF market is $7 trillion USD in AUM. That's 7 trillion with a T. Right? It's a very big number. In Canada, the AUM is something like 350 billion Canadian, right? So less than 1/20th the value, even though everything in the US generally is about 10 times the size. So there is a kind of a doubling of assets on a representational basis in the US relative to Canada. And I think that it's that tax advantage that has kind of accelerated the uptake there, even though Canada was the locus for the first ETF ever.
Yeah.
In the early 90s. I'm sure it's come up on this
tip.
podcast on many, exactly on, it's come up on this podcast and many others. The XIU has its roots in the first ETF ever launched. Canada had the first bond ETF. It had the first currency hedge ETF. It had the first physical crypto ETFs, the first marijuana ETFs, a lot of first kind of hedge fund-like ETFs that do very, very unique kind of long-short strategies, new since 2019 because of, relaxations in the rules around alternative mutual funds. So it's a world of firsts, but it's still proportionately small compared to the U.S. For all sorts of reasons, and I think the taxation component is one of them.
Do Canadian advisors and investors use ETFs the same way as U.S. advisors and investors use them, do you think? Like, do you see any differences in the behavior or how they fit into portfolios?
Yeah. So there's a lot of splintering in the way ETFs are used, right? They used to be used just for core allocations, and a lot of advisors especially use ETFs in a kind of core and explore fashion, where they would use the ETFs, the big giant placeholder for the center of an ETF, of a portfolio, of a managed portfolio. They would construct it out of building blocks going to all sorts of different asset classes, and then they would have exploratory positions either in individual securities, stocks, structured notes, what have you. And that's been a very good model. And we know that that's been applied in the US as well as in Canada. But now there's a splintering. People are using ETFs in manners that make my head spin. An example would be, certain thematic ETFs which have become memes unto themselves, right? Not something I would have predicted. We see in the early days, there have been major changes. So to your question, in the early days, advisors and investors did use ETFs quite a bit to rotate among sectors and geographies. Those were the tools that were on the shelf at the time. Then with the advent of all these different kind of smart beta ETFs, single factors, multi-factors, and so on, we saw a gradual and then sudden uptake in the use of individual factors and rotating amongst them depending on market conditions. And factors, in a sense, became sectors. People were using them strategically and tactically, sometimes rightly, sometimes wrongly. A case in point is what we observe in terms of low volatility ETF flows. In the aftermath of the financial crisis, which is again the kind of the fertile soil from which my career was born, right? There was so much demand for capital preservation and risk mitigation after having gone through the scarring experience of like 50% market drawdowns very, very suddenly. There was a boom in the development of the so-called low volatility ETFs, right? SPLV was the first one, then USMVs quickly followed. In Canada, we have ZLB and a whole bunch of others as well that track this factor. And it is a factor. It's an academic factor. It's an anomaly. What do you want to call it? But the inflows into this factor after the financial crisis were phenomenal. Year after year, many billions of dollars going in. And then what we saw in the last kind of corona apocalypse, the low vol factor, which had done very well for about 10 years, it kind of faltered a little bit, as every factor would expect it to do. No factor can win 100% of the time, right? In fact, if it wins 51% of the time, that's pretty good, right? Better than a coin toss. And what we saw with the low fall factor was that it in fact delivered what the academic practitioners and index developers said it would deliver through the Canadian oil crisis and crash. Those companies became the high vol companies, and the low vol ETFs rotated out of them. Those products did very well. In the backtest, certainly, they all avoided the financial crisis having rebalanced out of the bank stocks early enough. And if the backtest extended to the tech crash of 2002, it avoided that as well. And so in Canada, the low vol ETFs did circumnavigate the 2014, 2015 oil route. But then during 2020, they participated almost completely in the 30-some% drawdowns that we saw in the market, and in fact did not recover with the market at all because it was a growth-led recovery, and the high volatile FANG stocks and their ilk drove that recovery, cloud computing, all this kind of interesting stuff, which was not in the low vol indices, and as a result, they lagged. And investors flowed out of that product category in subsequent months. For the first time, we saw a big turning. When did these outflows occur? After the fact, right? So you have performance chasing, you have negative performance chasing. ETFs, factor strategies, sectors, they're wonderful, but they do not cure an investor's or even an advisor's worst tendency to performance chase and go after what just worked, right?
Yeah. Amen to that.
Yeah.
So how do you, on the desk,
Mm-hmm.
because, well, first of all, maybe tell us a little bit about what National Bank's ETF research desk does. And
Sure.
That might lead in a couple of directions that I'm keen to explore.
Yeah, no, great question. So one direction that it doesn't lead into is having a short list of recommended ETFs. We are often asked, what's on your recommended list? And I know that in the traditional world of fund analysis, having a recommended list is very powerful and a very helpful thing to advisors even. And I don't want to disparage that practice, because now that the world of ETFs and mutual funds is blending, I have to kind of blend myself into being not just an ETF analyst, but also a fund analyst. And so having a recommended list is something that is, it's a sacred tradition. I don't want to dump on it, but it's not something we do because so many ETFs are similar to one another, but with very minor differences that matter to the individual circumstance that you're in. Whereas other ETFs are, in fact, almost carbon copies of one another. That's one of the kind of dirty secrets of ETF analysis. There are dozens of ETFs that track the same index, and if they have the same structure and same fee and more or less the same market-making plumbing behind them, they're physically replicated. There's no synthetics. They can reinvest dividends. They don't have weird, old-fashioned kind of rules against that, like, for instance, SPY might in the U.S. because it's a UIT and not a 1940 Act fund. If ETFs are identical, we don't want to recommend one over another. That would send the wrong message, we feel, to the street, to our advisors who follow our research. So what we do, Adam, to answer your question, is we will consider the whole playing field, the whole landscape of potential ETFs that might qualify for the exposure a client or an advisor is looking for. And then we will work with the advisor or client to understand what they're trying to do on behalf of their clients. What are the kind of exposures they're really looking for? What are the risks that concern them? What else is happening in the portfolio? Where do they have any overlaps or gaps? And then we will give the advisor or whoever we're advising, because sometimes it's institutional clients of our trading desk, a menu of options with some analysis supporting why you might pick an ETF or another. So we really see our mission as education, as lifting the hood on every ETF that's out there and explaining how they work and how they might differ to anybody who wants to make a decision so that they can make a more informed decision. We do publish a model portfolio report, for instance, which does highlight in the tear sheets in the back and in back tests and so on, specific ETFs for specific exposures. But that's more of a kind of everything, including the kitchen sink kind of research product where we're trying to show the various different kinds of ETFs that could slot into a very, diversified portfolio. National Bank does have, for instance, UMAs and portfolio baskets of its own that it sells, and we don't manage those, but they do come to us and leverage our research capability when the actual PMs of those projects wish to make an allocation. They will use our research to help them decide which is the right one for the client, right? Very often, and in the early days especially, the decision would amount to this ETF is very large and liquid, has very narrow spreads, but it has a higher fee. This other ETF is a little bit newer. Its fee is a bit lower, has larger entry costs, but has a lower fee. So if you're going to trade tactically, go for the liquidity, prioritize that. If you're going to invest for the very long term, prioritize the ultimately low fee so that you can compound your returns for longer. And then there's a break-even point. What's the holding period? We're talking about basis points here, right? Very often, the decision does amount to understanding where those break-evens occur and how many basis points exactly we're talking about. But In the new era, we have to do so much more than just that, understanding the factor exposures, the concentration, and then sometimes, in fact, the structure. Is it in a corporate class? Is there a synthetic backdrop to it? How does it hold its international securities? There's so much that that can be done, and that each individual investor, because their own situations are different, we will try to custom and tailor our research for that particular investor. So that's all a very roundabout way of saying that it's a lot of work because there's a lot of individuals, right? And there's no cookie cutter solution for any one of them.
A lot of the major banks have, and I think this has been guided by the OSC, but they tightened the screws on know your product rules over the last year or so. You've also noticed a shift in the way, used to be that for the major banks, the asset management arm was a pretty substantial profit center. I mean, I remember the days when the Royal Bank balanced fund, maybe this is still true, but used to be a large mutual fund in Canada, and they, for a balanced for passive portfolio, effectively they were charging 2.4%. And I mean, obviously, ETF industry positioned to disintermediate that for the Canadian banks. I think the Canadian banks over the last little while have kind of retaliated by issuing their own suite of ETFs. So now every bank basically has their own suite of ETFs, and these new KYP rules may offer cover for these banks to make the case they know their own products the best, right? Have you noticed any shift way that advisors are using ETFs now as a lot of these sort of strategic and competitive forces manifest over the last couple of years?
Yeah. No, so you're absolutely right. There have been strategic and kind of marketing forces happening in the background of all this massive asset growth and product innovation that we've seen, and that is a big part of why the Canadian ETF industry is now at $320 billion. It's why it's been growing at 22% cumulative annual growth rate for the past 10 years, because there are decisions coming from the top that have discovered that the ETF works very well as part of for instance, a fee-based business model, right? If you're part of a bank and you have a slew of advisors who are, each engaging in their own kind of practice, encouraging a migration to fee-based is a way for you to get, as the parent bank, kind of revenue certainty, right, over other models. And when revenue is less volatile, cost of capital is cheaper. I mean, there's a lot of reasons to understand economically why that's in the interests of the parent bodies, but it does also happen to be in the interest of end investors as well. When you kind of look at the history of how in the kind of Wild West early days of commission-based business models, many clients may have found themselves encouraged to kind of perhaps overtrade their portfolios. Now, this is the amazing thing. ETFs are wonderful buy and hold vehicles, but they're not a silver bullet against that either, because they're so liquid and tradable. They may in fact still encourage perhaps excessive trading on the behalf of, as we see, even discount investors as well. So to go to what you're saying, I'll put it this way. When I started at National Bank, there were 4 ETF providers. Okay, BMO, I think, was one of the earlier banks on the scene. In fact, TD had ETFs prior to when I even joined, that they launched and delisted before I even got into this business. So at the time, there were 4 providers. And even though there have been some mergers and consolidations, we're now at 40, right? There was one bank at first. I mean, there was one, then 0, then another one. And now all 6 are in the business, including National Bank. National Bank Investments also, offers its own ETFs. And our research operation sees them as an important client, as all the banks are an important client, because it is like one big kind of, the Canadian banking industry, for better or for worse, it's a different kind of competitive landscape than it is in the U.S., right? And that very much does apply to banking and to ETF market making. There are a lot of kind of regulatory reasons why the Canadian, for instance, active ETF landscape has grown quite a bit faster than the US. 25% of our assets are active in Canada, as opposed to now what is something like 3, maybe pushing 4% in the US, when it was sub 1% for a very, very long time. And that's because...
So what drove that? What drove that difference? Well, why are there so many more active funds in Canada?
Great question. Yeah. So the primary reason for that is that the regulatory landscape is friendlier for active ETF portfolios in Canada than, until recently, it was in the United States. In the US, ETFs required, I believe, more like 2, sometimes 3 authorized participants, that's, designated market makers, to receive a fully transparent representation of the portfolio every single day in order to support the market making function. And that portfolio needed to be communicated in full and with total transparency every single day. A lot of active managers in the US, that would make them bristle, because they don't want to, you've probably heard this, they don't want to kind of tip their hand or reveal their secret sauce or anything like that. In Canada, for better or for worse, ETFs don't need to disclose their portfolios any more frequently than mutual funds do, which is quarterly with like a 1-month lag and only top 10 holding or something like that, and maybe only annually for the full portfolio. There's a lot of opacity that is afforded to active managers in Canada, which is what they want, so that they can kind of conceal their trades and kind of protect their asset management style from leakage onto the street. In Canada, an active manager is satisfied to, perhaps sign an NDA with an ETF market making desk or a few of them and say, please don't divulge my entire portfolio and trades to your own institutional equities desk, which is, just down the hall from you, Whereas in the US, that wouldn't even fly, right? There's less trust, on Wall Street than there is on Bay Street, probably because it's a bit, culturally more shark infested there. I don't want to say that the Bay Street and Wall Street culture is that different. It really isn't. But the Canadian environment is perhaps a little bit friendlier on many scores. Regulators are more supportive and friendlier towards the asset management industry, and so when active ETFs were first coming to market here, they got approval to be semi-transparent, which took a long time even in the United States, and now they have to go through all these unbelievable innovation and patent hoops in order to have active non-transparent portfolios, which is a relatively new innovation there, and may in fact spur whole new waves of growth, as we saw in 2021 when a number of large mutual fund providers started to convert, Dimensional being one of them. They converted about 40 billion in active funds to ETFs in 2021, and that was the first time that happened in the US. We haven't seen mutual funds convert to ETFs here in Canada, but we have seen mutual fund companies launch ETFs many times over, insurance companies as well. Manulife is there, Mackenzie is there, other funds like Dynamic partnered with iShares at first and now have their own ETF businesses. A lot of the ETFs in Canada that people would not necessarily even think of as active, we treat and think of as active because they don't track the third-party recognized index. BMO has been a pioneer of that, these kind of like algorithmically driven quasi-index-like strategies that are running with a black box on BMO's quantitative desk for just their dividend ETFs or even their low volatility ETFs. There's no third-party index that you can track. Those are effectively active, and those have been very popular.
And how have you and your team sort of adjusted to the explosion in that thematic space and the liquid alt space?
Sure. So the first thing we had to do to adjust the explosion was upgrade from Excel to SQL. That was the first thing we had to do, In fact, when I started at National Bank, the research department was still kind of spooling up in its Toronto office. And I had like a very old version of Excel on my PC when I sat down in my cubicle. I don't remember the precise calendar year of it, Excel 2000 something, but it only had 128 columns, right? A nice even power of 2. And I said, 128 columns, that's fine. There's 100 ETFs in Canada? This is plenty, no problem, And sure enough, I needed to keep a spreadsheet of the ETFs. I needed to break up again into 2 files. And when they finally upgraded to a newer version of Microsoft Office that allowed for I don't know how many tens of thousands of columns, I was like, okay, this is enough. But it wasn't really. We needed to migrate technologically to SQL and Python and other bunch of database tools just to run our statistics. So that was a big change. But now we're up to 1,200 ETFs in Canada, Mike. And I often get the question, is that too many? Are we due for a wave of consolidation? Is there going to be a moment of reckoning in the future where there's massive waves of delistings and termination. I don't think there will be because, not a lot of people can even answer how many mutual funds there are in Canada. I've looked it up myself, and I don't know how many there are. Sometimes I see the number 8,000 quoted, but when you count the alphabet soup of different kind of series and so on, A, O, F, C, D, I don't know how many letters there are, you get to something like 20,000 mutual funds. Nobody bats an eyelash. Nobody ever says that's too many, right? You could say that maybe there's too many S&P 500 ETFs because every provider has one, and they have a currency hedge version, and a whole bunch of them have USD versions as well. In the US, there are 3. Does Canada really even need more than that? So I don't know if there's going to be like maybe some differentiation on that score. But that is the most famous index in the world. If there was any index that's going to have like a dozen versions on the TSX, then it would be that one, right? I think that we are going to see many, many more ETFs launch because, it used to be that a theme, once it would start to resonate in mindshare, and we're talking about things like, robotics and automation, cloud computing, social media, and so on, there would be an ETF listed or launched that would kind of capitalize on that craze. Marijuana, the cannabis industry, another one. That ETF from Horizons launched before legalization, and it was originally a life sciences ETF tracking what was medical marijuana at the time. And now it just tracks the broader cannabis industry. And there were a few other ETFs that launched as well. One since delisted in that space because first mover advantage is very hard to dethrone. But I think the coming environment means that ETF providers and asset managers are going to have to try to guess what the next trend will be and try to plant the flag before anyone else even sets foot on the territory so that it can be there before that craze takes off. And that's, we saw that in the aftermath of the COVID sell-off with the phenomenal popularity of an airline ETF in the U.S. Some travel ETFs happen to be in the right place at the right time. I can't tell you how many advisors ask me, which ETF will give me the highest exposure to cruise lines? They asked me right at the peak of the pandemic, and I'm like, forget the coronavirus. Aren't you worried about like rotaviruses? And well, there's other viruses you can catch on a cruise. But I don't know if that industry will cover. Maybe I'm wrong. And we would show them that there are some consumer discretionary ETFs or some travel and leisure ETFs that have very high weights, and some of these very, very beaten down cruise companies. So travel has been a theme that needed to be on the exchange just as the demand was coming in. So I think that we will see a raft of launches from very creative and forward-thinking ETF issuers who are trying to imagine what will be the next theme. And that doesn't necessarily have to be kind of a subsector theme, right? Like virology or, gene therapy or mRNA treatments or something like that. It can be a quantitative theme. It can be an alt strategy that will soon come to be in demand, given the inflation fears that we're seeing in the economy right now, given the incredibly low prospects for returns from fixed income and so on. So I think that, or even given the long foretold death of the 60/40 portfolio, right? Those are an enormously popular category in Canada that have themselves been a gangbuster source of growth. These kind of balanced ETFs that first came from Vanguard in the form of ultra low cost products. But iShares, was quickly kind of retooled their lineup to compete. BMO launched their own. Horizons has some total return vehicles. We saw Fidelity just launch one with a little kind of crypto sleeve. But I think that, once, we start to see an in-sample period where the kind of 60/40 portfolio falters, because it hasn't really thus far. But you can easily imagine certain kind of market environments where it would. There will be demand for strategies that can prove themselves as delivering that kind of true diversification. And if they are on the exchange, if they're there now, then that live performance will be a better, imprimatur than any kind of piece of marketing collateral. And I think that that's what we're going to see in the next 3 to 5 years.
Well, I like that.
Yeah.
We've got, obviously, we manage an ETF in the Horizons group that does some of those types of things and thinks about that inflationary exposure and an impulse that might be happening. But that falls in this liquid alt category. So
Right.
Are you seeing enough product flow yet to start to categorize in that area?
Yeah.
Or is that something where you're looking at saying, oh, we've got a few entrants, but it hasn't had that impulse yet in Canada? Certainly in the US, there's a little bit more of that.
Right.
We've launched a paper called return stacking, which is, about having that 60-40 in the portfolio, but doing it in a way that allows for more portfolio real estate. So using some levered ETFs that give you the balanced fund, so you have less money exposed to that and can think about some alts within the portfolio. But we haven't seen those innovations quite take the grasp in Canada, and maybe because it's more an inflationary economy. But what are your thoughts there?
Yeah. I think there's a few reasons for why they haven't really started to kind of sprout up in terms of asset flows or even demand or even client questions. One of them is that when it comes to that category, in our experience, and this is anecdotal, advisors who are looking for those kinds of quant strategies really do like to see live in sample performance. And a case study for that would be smart beta ETFs. Certain kinds of smart beta or even single factor ETFs. There were some in Canada that launched, in the early 2010s, and then you could clearly see at the 1 year and 3 year anniversary small upticks in the flows. There's definitely market participants out there, sophisticated ETF users who do want to see minimum 1 year, and it would be ideally nicer to have longer track records demonstrated. Now, we all know that past performance is no, predictor of future, and that's true. But I think it is a reality that many of the target market for these kinds of alt ETFs, there's no replacing in their mind the benefit of an actual kind of live track record. So you will need to wait, I think, until those kind of windows roll over before you even start to see some fish nibble on those kinds of strategies. The other reason, I think, is the COVID crash, right? That kind of derailed a lot of, I think, plans and even thinking around investment. I mentioned earlier that it was 2019. I think it was announced in 2018. So it actually goes back quite a number of years now, because we are in 2022, right? Like, have we passed the Blade Runner date? I think, like this is the future, right? It was 2020. It was 2018. When I don't even want to think about Terminator 2 or something like that, because we're already in a nuclear smoking crater, if that's the alternate timeline we're talking about. But it was around 2017-18 when the framework around alts was undergoing some regulatory changes in Canada. We saw a raft of launches around such strategies, market neutral, from storied hedge fund managers in Canada who are attempting an ETF business of their own around this kind of newly opened up alt space with relaxed rules around concentration, around gross leverage, short positions, and so on. Really, really kind of opening up to investors kind of a kind of institutional power in asset management that had not heretofore been available to them. And then, a strange new kind of respiratory disease emerges overseas, and nobody's thinking about it anymore. These ETFs chugged along, and they had quite a bit of divergence in their performance. Most of them gave partial participation to the downside because everything went on sale, right? And those few that outperformed during the kind of spring 2020 period when the markets were selling off gave back their gains because they had short positions in high beta stocks and so on. And I think that that kind of giant global macro event pushed the Canadian kind of investor mindset into placing the kind of alt idea onto the back burner. But it's going to come back. Another example is ESG, right? ESG was another massive buzzword. It had a lot of hype and headlines heading into the Corona apocalypse. The COVID crash occurred, and the ESG conversation disappeared, right? The products were still there, but it's come back. And it came back faster than I thought it would, right? I thought that that the diminishment in concern around ESGs after that crash would kind of scar investors a little bit, and a lot of people would react the way they did after the 2008-09 crash, which was, I don't care what you do with my money, just protect my capital. So many investors kind of had that mindset coming out of 2008 or 9. But now I think with the kind of dramatic and historic interventions and the very surprising bull recovery that occurred in the aftermath, the ESG conversation is back. It's back in force in a way that makes people think, there is a connection. It's a bit of a logical leap, but there is a connection. There is a tie between ESG and globalization and the spread of pandemics and transparency and awareness of these things. We live in a connected world, and that part of the conversation has come back. And I think it will happen with alts as well.
So,
well, like tech also typically ranks highly at ESG.
That's right. Yeah.
Another
ranking.
Coincidence.
Yeah, it is.
Yeah.
It's true. Like a lot, like Microsoft, Apple, all those companies have huge footprints in a lot of those indices and high scores from ESG ratings agencies. Because when your business is in the air, when it's in the cloud, you can't despoil the earth, right? As much as an actual extractive traditional industry or oil company. But we rely on those things.
So we had Daniel, we had an exceptional near 2-year period there leading up to late last year.
Mm-hmm.
And then we've had the specter of inflation come back. It's caused some upheaval this month, in the month of January 22. And what I'm curious to know, from a macro standpoint, because you're overlooking the entire ETF industry, how did things change from late last year till now? What have you sort of witnessed happen this last month with flows in and out of the market? What are you seeing?
Sure. Yeah, that's a good question. So I can tell you, just when it comes to the macro viewpoint, I'm very fortunate to work for, National Bank. We're not just an ETF research arm that's kind of amputated from a larger organization. National Bank has its own chief economist and a really good CIO office and an asset allocation team. And we very much rely on their outlook and commentary when it comes to macro calls. And in fact, what we'll do is we'll often map it to the right ETFs to kind of align it with their calls. What we found in 2021 was a pattern of flows, the likes of which, had not been witnessed in history. And we had previous years of gangbuster ETF flows. But 2021 really kind of blew the roof off the place, both in Canada and the US. And it wasn't just ETFs, it was also mutual funds, right? So in 2021, ETFs had 53 billion in inflows in Canada, which was fully 1/3 higher than any prior year. And in the US, the amount of inflows in the US was something like 900 billion. It was almost $1 trillion, which again was also 20-some% higher than the past record set in 2017 or something like that. I'm not exactly sure when the prior record was broken, but suffice to say, 2021 was enormous. It was enormous for mutual funds as well. And why is this happening? We got that question many times. What explains all this? And it's a post-pandemic phenomenon, right? There's this is wealth effect going on where unprecedented stimulative action has kind of put enormous amounts of money in the hands of regular investors, or at least a certain tranche of them, which is whether I don't know if you want to call them 1%ers, but it is the upper quartiles of the Canadian wealth distribution happened to do well financially through this pandemic. It's kind of hard to say so, and I have to wonder if policymakers are going to look back on it and wonder if they could have done things differently, because it was a hard pandemic for a lot of people, right? Frontline workers, doctors, medical professionals. A lot of restaurateurs and gym owners had a rough go of it. But I feel very fortunate that the demand for ETF research was never higher. And aside from a kind of brief momentary period where my emergency deployed laptop wasn't really kind of fast enough, we were able to do our ETF research without nary a speed bump through that period. So, what we saw through 2021 and going into January, even with all the volatility that kicked off the year, 2022, I keep needing to remind myself that it's 2022, kind of astonishing, is that people are still using ETFs to express quick and immediate access, right? When there's a big sell-off, we see inflows into cheap beta, into passive, right? People sell their direct holdings in their stocks, and then when it comes time to get exposure quickly, they don't know where to allocate immediately. They'll do it with the cheap default product. And so we see enormous equity flows at a time when equities are selling off. It's something we still observe, right? We often get the question amongst ETF doubters, right, against the muckrakers that ETFs are going to destabilize the market when push comes to shove and there's a giant sell-off. There'll be blood on the streets because these ETF holders are going to dump their products, and they've been accustomed to this enormous liquidity. It's going to trigger some kind of snowball effect. I'm not exactly sure how the argument works, because not only do I not buy it, but the evidence doesn't bear it out. There have been massive market disruptions and huge sell-offs over and over again in even illiquid markets like high-yield bonds, senior loans, and so on. And what we saw was, the underlying market can break down, as it did in 2020. The underlying bond market in the U.S. especially, and the entire Canadian corporate bond market as well, completely froze up. But the ETFs, they developed on-screen discounts, but they still traded through the day without interruption and provided access and liquidity when nothing else would. And in fact, there's reason to believe that they created some kind of liquidity release valve into the market and may have in fact increased the stability of the wider bond market and come to the rescue. Certainly in the US, ETFs came to the rescue of the wider mutual fund complex because the Fed started buying them, right? In order to kind of staunch redemptions that were going to start happening in mutual funds. And that may indeed have been a kind of liquidity doom loop scenario that we don't really much want to think about, right? ETFs are still a small section of the market. So Pierre, to your question, they have about 10 to 12% market share relative to mutual funds. In Canada, about 20% in the US. That means that the equilibrium point between ETFs and other forms of asset management is still very much a minority. ETFs are still very much a minority. And when there's large shakeups, you're going to see capital flow to the ETF complex because, in physics, we talk about a diffusion equation. When you have a very large body connect to a smaller vessel through kind of a narrow inlet, and there's turbulence and exchanges of pressure, particles are just going to flow from the higher concentration to the lower concentration zones. And the ability and access to do so, the speed bumps that people encounter are in fact they're tax situations, right? So that's the real limiting factor to why someone might not choose to immediately allocate to a cheaper, better vehicle for exposure to, let's say, U.S. equities. So we did see significant flows into the landscape of U.S. equities in the last couple of weeks, even as the markets were experiencing untold volatility. We saw large outflows from Canada, which I thought was a little surprising, given that Canada is, traditionally a great inflation play, right? Energy economy, the banks as well, which are very much correlated with the major energy businesses that are their primary clients. Not only that, but being banks, they too could benefit from a steepening of the yield curve if we enter into kind of a rate hiking cycle. So I would say that our macroeconomists see Canada as a kind of natural resting spot for people who are fearful about the kind of inflationary environment we're heading into. But we haven't really seen a lot of flows into Canadian equity ETFs in the near term. I think that should that happen, it will happen over a longer time scale, and we would need to collect a few quarters of data before we really see people using Canadian equity ETFs as a kind of trade vehicle for this kind of inflationary environment, which we may or may not be heading into.
So when you say you saw redemption, so you're saying in Canada, on Canadian-based ETFs broadly listed in Canada, you saw redemptions in that space over this period of time, and that money, I'm assuming, was headed towards the U.S. sort of market cap weighted or tech weighted areas? Yeah.
So that's exactly what we saw. And the data hasn't fully come in for the entire month of January. I mean, we're on the last calendar date of January. So in the next day or two, if you're listening to this podcast, it'll probably be out a report for January 2022. There's that year again. I have to remember on my checks and so on. It's crazy.
You're still writing checks.
That's right. What are they? I don't know. Right. Just as collector's items, people want to keep my signature. I'm just kidding. Yes, we saw major redemptions from Canada, from passive Canadian equity
Wow.
ETFs. The problem is that some of those redemptions can be quite choppy because there are certain ETFs in the Canadian market that have very, very choppy inflow and outflows on short time scales because there are large, international, overseas hedge funds managers and so on who use it very much as a kind of tactical petro play, for better or for worse. And in fact, some of the Canadian ETFs may be getting employed by international investors that way. And if the relative performance of Canada versus the U.S. through January was higher, and if there's some kind of rotations or profit taking or relative profit taking going on,
rebalancing, even.
Exactly, then that might have prompted one or two large trades through the month of January. So I think that we'll have to be a couple of months into the year before we really see whether that kind of phenomenon is going on. I know that our institutional equities trading desk is very interested to know, is Canada for sale via the mechanism of ETFs? It's something we saw in 2014-15, right? Like when oil was for sale, that was one of the, Canadian equity ETFs were being dumped left and right. But I don't know if that's the right move for this coming environment. And, the data remains to be collected.
It sounds like...
that's where my mind went was, just I want to follow up on this here, that my mind went that it was potentially more international flows that actually would have been coming in to Canada to capitalize on sort of the resource-based economy. And but then you've got the counterflows of rebalancing, and then you've got the counterflows of investors who have been waiting to get a spot in the tech correction because they felt underexposed. So you've got all kinds of dimensions to the investor decision that you're trying to suss out of this big pool of capital that has moved around.
Yeah, exactly. And we talk about ETFs being transparent and being visible, and we can see their activity on the exchanges very clearly. But the actual holders of them are anonymized, right? We don't really know who is driving what capital where. If you look at for instance, just the month of January, I think there was one particular international ex-Japan ETF that got something like 3 billion of inflows very suddenly in one day, Who on earth, it kind of makes sense to think that it was like the Bank of Japan doing that, right? Because they have been a massive buyer of Japanese equities, and in fact, probably very, very overexposed. So if they needed to get like some kind of ex-Japan exposure, it could have been that institute. We don't know. And we can't know because the trading is anonymized. And in fact, that's why so many institutions love ETFs, right? They can cover their tracks, so to speak, right? Better via the mechanism of ETFs, especially if they have large stock positions. They can blend it in with ETFs. They can go long, short certain positions. They can kind of strip out individual company exposures. And that is one of the many kind of arrows in the quiver of an institutional manager that they can use, particularly if they want to transact in large amounts in the marketplace suddenly and on a dime without necessarily telegraphing to the whole street that they're making a particular company call, right?
How do you deal with $3 billion of inflows? Jesus.
It's doable, and it's not the first time we've seen such unbelievable sudden flows, but it just goes to show that when a basket is incredibly well diversified over thousands and thousands of stocks, all the stocks can be individually illiquid. But when an ETF is that diversified, $3 billion, when you spread it, when you thin slice it across many, many, many different holdings, you won't make more than a 10% volume impact in any one of the individual constituents, even in a single day, right? It's a way that an ETF that holds, we found on certain timescales, it depends when you analyze the volumes. But for instance, Canada has the TSX 60 index, but it also has the TSX Composite index. The TSX 60 holds the 60 large cap. The TSX Composite goes into mid and small caps, not really super small, but 240 some holdings. Depending on the time period, their liquidity, of the underlying basket, the implied liquidity of the composite can sometimes be higher than TSX 60. Even though it holds much smaller, less liquid companies. That's because it's a fat tail of liquidity distribution that occurs as you stretch down the line of smaller companies. And then when you have more room for your capital to flow into as you're creating a large trade instantaneously, it's all algorithmic, right? Our market makers just they push a button and it happens automatically in the blink of an eye. And it is somewhat miraculous, and it's something that kind of astonishes me every day. We see it in fixed income. We get clients all the time who say, can you prove to me that a fixed income ETF can accommodate such volume. It's much easier to kind of demonstrate it to them by, really parting the curtain on the portfolio and saying this bond can hold this much volume and so on. It's something that's far more doable in the world of equities, and we have a kind of model to simulate on the back end what a market maker would do if they're kind of creating a basket, how they can optimize, how they can strip out the bottleneck securities, how they can put in proxies and so on. Fixed income is much harder because the bond trading market isn't as transparent. But each ETF market making desk is a bond trading desk in miniature, and they know how liquid the securities are. And when they're quoting, they're competing with one another. So you're relying on that competitive mechanism. And we can see in history many times when what should be an illiquid product actually, because it holds hundreds of securities, bonds in particular, that haven't traded for days, if not weeks, suddenly accommodate billions of dollars of flow in an instant without, right there on the bid or on the ask. It's something that has been demonstrated historically many times, and we kind of saved those examples as snapshots on our Bloomberg just to give some clients comfort that the deep pool of liquidity does indeed underlie this particular fixed income ETF. Not all, but some.
So that's a really good point to offer some advice to those who are portfolio managers out there who are trading ETFs. How should they, they're doing $100 million order across their book, and how should they think about that? What tactics should they take? Should they call their ETF desk? Right. What are some tips and tricks so that they don't find themselves with a fill that's 4 or 5% off the NAV?
So that's a great question, Mike. And in fact, when we published on this, when the Canadian Securities Authority had amended some of its rules around fact sheet disclosures around effective spreads, because we wanted to communicate to advisors how to interpret this data point, right? ETFs have a bid-ask spread, but like all stock-like securities that trade on an exchange, they also have an effective spread, which dives into the order book to kind of see how big the order would be at certain notional trade sizes, right? We find that we calculate this figure for ETFs all the time. We used to publish on it very, very frequently, but it's difficult to do so, but we did do that. But now that every fact sheet has an effective spread on it, we published a piece in 2016, which again seems like ages ago, on how to interpret that. And in that piece, we had a list of trading hygiene tips. So that answers your question. And I know that I'm not going to remember all of them right now. I wish I had it in front of me, but one of them, of course, is to use limit orders and not market orders. And trade, if you can avoid it or away from right after the open and right before the close, because the risk in hedging increases a little bit for market makers around that time for some securities, particularly those that have illiquid baskets. The other one is you can check implied liquidity if you know how the TSX has tools, Bloomberg has tools. Advisors may be able to access those kinds of metrics from third-party data vendors. You can come to us if you have access to our ETF research desk, and we will be able to communicate to you the kind of liquidity that actually exists in the ETF. And yes, if you do have access to an ETF market maker and you can, your retail trading desk can get a line in with them, you can work with your ETF market makers to really understand in real time precisely the kind of liquidity that is available in an ETF. It's not necessarily the case, and this is a drum that we've been beating for 12 years. As long as I've been doing this, it's not necessarily the case that an ETF with no volume has no liquidity. In fact, an ETF with no volume can be just as liquid as the most liquid ETF out there because of that, of the creation redemption mechanism. And it's not necessarily the case that an ETF that is highly liquid is as liquid as, let's say, that trades a lot with very high volume is as liquid as a stock that trades with that volume. And what do I mean by that? Sometimes what you'll get, and this is something we described in our report on the 2020 era bond ETF apparent dislocations in premium discount to NAV. Sometimes what happens is you'll have a very, very tight bid-ask spread band around, let's say, the ask of the basket spread if the ETF is itself enjoying a lot of demand, right? But then as soon as there's a lot of supply, if the natural unit holders of the ETF all start dumping their shares simultaneously, and the market maker, what you'll see is that ETF's actual trading price on the exchange cross the basket spread. And there'll be a new small bid-ask spread around, the bid price of the basket if there's herding behavior in an ETF. So if there's herding in an ETF that is illiquid, what it will look like is premiums and discounts, big premiums and discounts, because the NAV is, in a sense, fictitious, right? Nothing has a single price. Everything has two prices. Your house, your car, this pen, your collector's items, your Bitcoins, everything has two prices. It has a bid and an offer. And it stems from the liquidity and the supply-demand mechanics around the underlying asset. And those prices are passed on to individuals on an exchange. It's why ETFs are so powerful and efficient. If you're a long-term unit holder, the kind of activity of buyers and sellers doesn't affect you as much. All those costs are externalized, right? So there are examples of, let's say, senior loan ETFs where the underlying basket is 1%. The basket spread is, the bid-ask spread ratio is 100 basis points. The ETF apparently has a very narrow spread because it's a very high volume. But if sentiment around the buying and selling of that ETF changes, you will find yourself in price action on the exchange crossing a spread. It's a bit of a sophisticated topic. I hope I didn't get too technical and head spinning on it, but we did write a report on it, and I have some cartoons and some data to illustrate it. It is part of our education process when we get into the ETF 301, the grad school material when we're advising clients, right? And as you can tell from the top of the hour, to bring it all back, I love school. I would go back to grad school if I could. Maybe I'll teach a course in this one day.
Is there a place where advisors and allocators could find that piece of research, that it's available publicly, or is that something that is available only directly from your team?
Yeah, so it's available through our team. We have something of a unique franchise at National Bank. I'm an analyst, just like any other analyst in our research department. I have a coverage universe, right? I'm not making calls. I'm not setting price targets. And my coverage universe isn't an industrial sector of, let's say, like a dozen companies. My coverage universe is the 3,000 ETFs between Canada and the U.S. We publish research reports that are available to clients of National Bank. If you and that could be any client, because they're compliance for wide release, just like any other analyst report of National Bank. So if you are even, let's say, a discount client of National, you'll find a little kind of research portal where you can receive our reports. On a one-to-one kind of personal correspondence basis, anybody who gets in touch with me, I'm happy to share PDFs of our research reports, especially deep cuts from the back catalog, because those are, we work very hard on them, and they may still have a bit of a shelf life, even though they're not as current as they once were. But yeah, anybody is welcome to get in touch with me, and I'll share my research directly.
Awesome. Well, I'm curious about another thing, Daniel.
Sure.
Carbon nanotubes.
Yeah, so they're little tubules of graphene. They have amazing properties. Carbon is a miracle material. We're carbon-based life forms, right? The carbon atom, its bond can form unbelievably complex structures, and one of the, in fact, simpler structures it can form is a perfect hexagonal sheet, like a honeycomb lattice. And when you roll it up into a little tube, you get these incredible properties that could be they could be semiconducting, they could have optical properties, they have high tensile strength, they're very absorptive of light, all sorts of incredible technological applications. I don't think you'll see massive commercial application even at this time, but what was amazing is right as I was finishing up my thesis, the guy who discovered superconductivity in graphene, which is an unrolled sheet of carbon, won the Nobel Prize. So it was it was a separate, if I had been studying that from the beginning, maybe I would have, had different academic prospects. But carbon nanotubes, they're very cool. You could make the cable for a space elevator out of them.
Yeah, well, I was curious because, what would motivate you to do your doctoral thesis on that? Mm-hmm. So, I mean, there had to be a reason. I wanted to ask you at the beginning, but we got to talking about ETFs.
Yeah. ETFs are cool too.
That ETF topic.
I like to think of ETFs as the nanotubes of the financial universe.
I'm not sure where Adam went to.
I think, according to the.
Oh wait.
So Adam, I don't know if he can see us, but Adam, if you're still there, don't hang up.
Okay. The one question I had I think we've been at this for about an hour. The conversation has been fantastic, and I think. We'll get back at it too at some point. We'll have you back on if you'd grace us with some more time, because I think it's been an amazing conversation and wide ranging. You did say you're a science fiction fan, and I wondered what is your favorite science fiction book or series?
Oh boy, well I have a lot that are my favorite. Probably one that's very formative and in fact surprising to me to be in the news again. Is Snow Crash by Neil Stephenson, right? That's the book that had the term metaverse instead of cyberspace. It was at the time even itself a satire of the emerging cyberpunk genre. He also coined the term, I believe, avatar in there for your kind of digital representation. And he had to tweet recently that he has no affiliation whatsoever with Facebook's rebrand to Meta Platforms. But there are several metaverse ETFs now too. And when I read that book in high school, if you had told me that I'd be an ETF analyst in 20 some years and there will be an ETF, not one but several, with the word metaverse in the name, I would have been very, very surprised. So that's exciting. But a recent book I read, a little more of a novella really, that I really enjoyed is called "This Is How You Lose the Time War" by Max Gladstone and Amal Al-Motar, who's actually, I believe, in Ottawa right now, my hometown. A really, really fun kind of epistolary time travel, fiction, romance, spy story. They wrote it together as letters between them, collaborators. I found that very cool and interesting. I read the science fiction collection of both of them by Ted Chiang recently as well. The whole world was telling me to read that for a very long time, and I finally got to it. And again, it's now ranks amongst my favorites. So I can talk about this for a long time. If you wanted to make this a science fiction podcast, amazing. We can start now.
I think we got to do another podcast on that with Adam, because he is a big fan of that space. I'm a tourist, and I do enjoy it, but I don't have quite the depth of knowledge. But amazing to have you on. And where can people find you, and where can people reach out to you, or where would they?
I work for a bank. I do have a Twitter account. I'm a hardcore lurker. Mike, I follow your and Adam's work. All the Resolve guys are, FinTwit participants par excellence. It's and I have enormous FOMO seeing the fun you guys have out there. I was tweeting until 2014 when I was promoted to full analyst, and the social media policy at our bank means that most of the words that come out of my mouth can possibly be construed as research. So I that made me a little paranoid. Maybe one day I'll re-enter that world when I get some kind of media policy and public relations clarity around whether I can participate in the social media. I don't have kind of a public facing, shall we say, Twitter profile where we share ETF research, but you can email me at etfresearch@nbc.ca is the collective ETF research email address for the entire team. And we receive dozens of queries to that address a day. It goes into a container, and we take pride in having very fast turnaround and getting back to people very quickly if they have ETF questions. So if you're a client of National Bank in any capacity, you have access to our full-fledged ETF research desk.
Awesome.
Love it. Adam, you missed the conversation about favorite science fiction books, bro.
Yeah.
That's right. Yeah.
Of course I did.
Yeah.
Inevitably.
Just for edification, do tell them what they were. I've already forgotten.
So, it goes all the way from Snow Crash by Neil Stevenson to the collections of Ted Chiang, and more recently, This Is How You Lose the Time War by Max Gladstone and Amal Al-Motar, which is really fun time travel, epistolary, romance novel, spy thriller. 200-page novella. You'll finish it in an afternoon. It was wonderful. More poetry than science fiction.
Who's that by again?
It's by Max Gladstone, and I believe the last name is Amal Al-Motar. I'm probably mispronouncing it, but it was written as an epistolary correspondence between two science fiction writers, not knowing what the other would write to the other. So it was itself something of a social experiment, and it was absolutely delightful. I hardly read as many books as I could anymore. I find that this modern internet age has kind of collapsed my attention span. I used to be able to read novels, very frequently, but now I find that I need to bombard all of my senses with a novel if I am to consume it. So I need to have the audiobook playing, and I need to have the physical book, and I need to have the ebook, all three immediately at hand so that I can have a hope of finishing it, right?
The ebook and the paper version.
That's right.
And the audio.
Yeah, that's right. Publishers love me because I buy their books 3 times over.
3 times.
But the thing that's the most stimulating is the audiobook, I find. Like when you listen to audiobooks.
Yeah, they're amazing.
They're more.
Oh, there's another one of my favorites, Gnomon by Nick Harkaway. So that's a fantastic book that I bought 3 times. Nick Harkaway is a British writer. I don't know how often it's known or shared, but he's actually the son of John le Carré.
Wow.
Just coincidence. Fantastic writer in his own right. And he writes science fiction. His first book, The Gone Away World, a fantastic, fun, satirical, hilarious kung fu dystopian romp. Okay? And then his book, Nyoman, was like an intricate 4-part, multi-dimensional puzzle that had to be unlocked in your brain as you read it. And it was by far the most stimulating thing I read in recent memory. Absolutely fantastic. Nyoman. Spelled with a G, Gnomon, which is the thing that sticks up from a sundial that casts a shadow that lets you tell all the time, by Nick Harkaway. And the audio book, the reading, the actor is famous British voice actor who does the audiobook reading of it. And I read the physical book and the ebook at the same time. I was switching in order to finish it, right? He does an amazing job. That book is told in multiple voices, and it's just I still think about it. In fact, when I'm lie awake at night, I find myself automatically kind of going to that book, and I do need to reread it again. That book itself would spawn an entire podcast series from me if I had a chance to kind of workshop it.
Wow,
that sounds amazing.
Yeah.
Daniel, thank you so much. Thank you so much for your time and for sharing a little sliver of your encyclopedic knowledge. It's been a wonderful conversation.
Yeah. Thank you so much, guys. It's been really fun, and look forward to a lot of really awesome more episodes from you. I've discovered you on Spotify, so I know that's been coming in for some controversy in terms of what kind of content it hosts.
Yeah.
But it's definitely one of my favorite streams now, and I got to find you on some other platforms if I decide to join the boycotts. I don't know. Not saying I will, but
we're on all of them, so you'll be fine.
All right, fantastic.
Okay, and we're not taking a stand against Rogan. I think Adam's having a little bit of audio challenges, so he's remaining silent, but not by choice, but by design. I muted him, so because I wanted to monopolize the conversation, as you all might know me. I love my voice.
Yeah. So thanks so much. Thanks all of you. It's been a lot of fun for me.